What's up, traders? So, I've been talking on social media today with some newer traders who are using multiple time frame analysis, but they're doing it wrong. Now, like many things in trading, there's no one right answer to do things, whether it's profit taking or multiple time frame analysis. But there is one wrong way. And that wrong way is using too many time frames to do multiple time frame analysis. You should have a difference in the time frames that makes sense, that allows you to go between different elements of time and see the broader picture as you're trading and analyzing a chart. I did a video just the other day talking about how to combine multiple time frame analysis to quickly go through charts like this. But the mistake I'm seeing made, and this is an example, I'm not going to name names, but it's great to teach from this. A trader was using the 30-minute, the 45-minute, and the 1 hour to do an analysis. Now, what's the problem with that? Is the 45-minute really that much different than the other two time frames? No, not really. So we're looking at a 30-minute right now of Bitcoin. It's still in a bullish trend, but it's starting to do a pullback. And if we go up to, let's say, the 45-minute, well, that doesn't really make much of a difference. If we go to the 1 hour, once again, a slight discrepancy, but we're not really seeing a different picture. And the only thing this can do by using too many time frames is just confuse traders. Because if we see, say, a moving average cross on the 30-minute, but it hasn't crossed yet on the 45-minute, then we're going to have a conflict and we're not going to be able to resolve that. We're not going to get anything out of using those two time frames. And I guarantee you that using things that close is not going to make you more efficient with your analysis. So, what are the linkages that we should use? Well, as I said, there's no one right answer, but these are the linkages that I use that I think is a really good idea. So, we have three different segments, and these are the types of traders perhaps that we use them. Ideally, you want to use all three segments of day trading, swing trading, and long term. That way, you can capture some really big moves with low risk on the lower time frames that can hopefully work out on the longer time frame. So, in the day trading realm, you have the time frame of the 1 minute, the 5 minute, and the 10 minute. Let's keep it at that. And then on the swing trading, which is going to be like a 2 day to 2 week, maybe a month, you'd be okay looking at the 30-minute, the 1 hour, the 2 hour, the 4 hour. And then the long term is, of course, the daily, weekly, and monthly. Now, notice I've got these in two columns. These would be linkages that you would want to use together. Let's not mix the two. We really want to pick something from the day trading realm, either the 1 minute or the 5 minute, and then match it up with the 30-minute or the 2 hour, and then match that up with the daily. Really, if you want to keep things simple, pick something from each zone out of one of these two columns and try that. Stick with it. Alternatively, you can scroll through the 1, the 5, the 30, the 2 hour, and upwards, and that will be okay. But keep these separate. In other words, if you're going to use this, that's fine on the left-hand side. Or you could take a little bit of a broader view, less charts that you have to look at. Maybe just look at the 10-minute, the 1 hour, the 4 hour, the daily, and that could be your analysis of the chart. And again, multiple time frame analysis allows you to get a very good picture of what a chart is actually, what an instrument is doing on its charts without looking at a million different time frames. Just pick something from this segment, scroll through it, and then if you don't see something you like, find another opportunity. There's thousands of stocks, there's hundreds of crypto. You don't need to focus on one thing and try to find something that justifies your case. So often I find traders that will look at a chart, maybe the setup's there, maybe it's not, but they want it to be there. They already have this preconceived notion that they want something to happen. And they're going to go to a time frame to find justification. That's not good. That's not how you should do trading. Trading is about finding opportunity, waiting for opportunity to happen, and then going based on your rules. So again, if we're going to do a quick analysis of, let's just say, Bitcoin. If we can start from the top down at the weekly, bullish trend, daily, bullish trend. Let's choose the fewest example. Let's go to the 4 hour, because this is going to break up that daily into smaller segments. Okay, now here we see a little bit of a difference. It is a bullish trend, but we see how it's pulled back to this MA right here. So we're getting to that realm where we know that on the daily it's bullish, but it's pulled back to a level that could be an opportunity. What is it doing on the 1 hour? Well, on the 1 hour, we now see that it's starting to do counter trend. See, if you look at a lower time frame, you're going to see sometimes the opposite of a higher time frame. We know from the top down that Bitcoin is going up. It doesn't take a genius to see that. But the lower we go in the time frames, we'll see a different picture. A bearish trend, like we see here on the 10-minute, on the lower time frame, is really just a pullback on the next higher time frame. This is the fractal nature of multiple time frame analysis, where you can find these short-term movements that will look completely different on a higher time frame. But you always have to remember, what is the higher time frame story? This is what rules. This is what is going to determine the trend. So you may get caught up too much on the lower time frame where things can look bearish, but you can't forget what's going on in the higher time frame. And that's why it's really beneficial to be able to switch through just a few and get the actual picture. A little update on a trade that I posted, which I'll link below. Here's another example of using multiple time frame analysis. This was MU, which was from earlier in this week. So if we look here on the daily, we see that this was making a triple top. But then on the swing trading level, on the 30-minute, this was our trigger to entry, because again, we had a really cool triple top even on the swing time frames. And without having to zoom all the way out and see the big picture and get confused by all this mess, we're able to capture this. So, hope this helps break down what time frames you should use, or rather what you shouldn't use, so that you can trade wisely. We'll see you in the next video.